Ascend your mind. Thank you for being here with me. There's a question circulating across Wall Street, Tokyo, Singapore, and every major trading desk in the world right now. And it's a question I believe everyone needs to understand, not just professional traders. Is the USD/JPY heading toward a major collapse? Or is the world completely misreading what's really happening? Now, I know currency topics can feel complicated, but today, I want to explain this in a way that makes sense to anyone, not with jargon, not with academic language, but with logic, storytelling, and simple cause and effect. Let's start by taking a step back, because the answer doesn't begin with today's headlines. It actually began almost 2 decades ago with a decision Japan made that shaped the entire global financial system. For nearly 17 years, the Bank of Japan kept interest rates at or near zero. To someone outside finance, that might sound strange, almost unnatural. But when you understand the context, it becomes much clearer. During that period, Japan's economy behaved almost like an elderly person, slow, cautious, spending very little, and struggling to generate energy. Inflation was barely visible, sometimes even negative. The population was aging faster than any major nation on the planet. People saved their money because they were worried about the future, and companies avoided risk. In an environment like that, raising interest rates would have slowed the economy even more. So Japan chose the only path that made sense at that time. Keep money extremely cheap, keep the system breathing, keep the heart beating. But something changed, and this is where the story becomes very different. In 2024 and 2025, Japan finally saw what it had been waiting for. Real, sustainable inflation. Not runaway inflation like parts of the West experienced, but steady inflation above 2% for more than 20 months. Wages began rising at rates Japan hadn't seen since the late 1990s. And the yen weakened dramatically, falling to 161 per dollar, a level unseen in 30-plus years. At that point, Japan could no longer pretend the old world still existed. The Bank of Japan had to pivot, slowly but unmistakably. And that pivot sent ripples through every corner of the global currency market. But here's the part most people misunderstand. The USD/JPY doesn't move because of dramatic announcements or media headlines. It moves because of yield spread, the difference between interest rates in the United States and interest rates in Japan. And to understand the yen today, you have to understand that difference deeply. Picture 2 mountains. The United States stands tall with interest rates around 5%. Japan is a small hillside with rates near zero. And just like water, money flows from the lower ground to the higher ground. It's natural, it's predictable, and it's the foundation of one of the most profitable strategies in modern finance, the yen carry trade. Now, if you've never heard that phrase before, don't worry. Let me simplify it. Imagine you could borrow lemonade for almost nothing from one store, walk across the street, and sell it for 5 times the price at another store. You would make money every single day. That's the carry trade. Investors borrow yen at extremely low interest. They convert that yen into dollars. They invest in U.S. assets paying far higher returns, and they pocket the difference. As long as markets stay calm, this strategy feels like free money. And because it has worked for so long, the yen carry trade has grown into something enormous, a pillar of global capital flows. But here's the truth I want everyone listening to understand. Carry trades rise slowly, and they collapse suddenly. And the force that destroys them isn't news, isn't policy, and isn't even logic. It's fear. Whenever fear enters the financial system, whether from a recession signal, a geopolitical surprise, or a sharp decline in stocks, investors immediately shift into what we call risk-off mode. I don't want you to think of risk-off as a technical term. Think of it as this. Imagine a beach full of people swimming. The water is warm, the sun is out, everyone feels safe. That's the normal market. Then someone thinks they see a big wave forming far in the distance. Maybe it's nothing. Maybe it's something. But people panic anyway. Everyone rushes out of the water at the same time. That moment, that sudden shift from calm to fear, is risk-off. And when risk-off hits, hedge funds and institutional investors don't have the luxury of waiting. They must unwind their carry trades. And to unwind, they must buy back yen. Lots of it, all at once. That's when the yen strengthens violently. That's when the USD/JPY pair collapses. And that's exactly what happened during one of the most famous currency events in history. Back in 1998, George Soros made billions, not because he guessed right, but because he understood the fragility of carry trades. He saw markets becoming nervous. He saw the yen oversold. He saw interest rate differences beginning to shift. And he knew, before most people, that when fear enters the system, carry traders stampede for the exit. When the unwind began, the USD/JPY collapsed in a matter of weeks. The yen surged, the carry trade blew up, and Soros walked away with enormous gains. And here is why this matters today. In 2025, we are seeing conditions that rhyme with that moment. Not perfectly, but clearly. Japan is slowly raising rates. The US is preparing to cut in 2025. The yield spread is narrowing step by step. The yen is historically oversold, and global markets are showing cracks beneath the surface. Stocks are stretched. Credit markets are sensitive. Geopolitical tensions remain elevated. This doesn't guarantee a collapse, but it creates a structure where a collapse becomes possible, perhaps even likely, if the right shock hits the system. And that brings me to my own view. I don't believe the USD/JPY will collapse because of a headline or a scheduled meeting. It won't collapse because a single central bank decided something. As long as the world remains calm, the carry trade will remain intact and the yen will stay weak. But if we get a real risk-off moment, the kind that shakes markets, the unwind could be fast, brutal, and impossible to stop. In that moment, the yen can strengthen 8 to 12% in just weeks. That is the true nature of the carry trade. It whispers on the way up, and it screams on the way down. So the question we should all be asking is not, will Japan hike again, or when will the Fed cut? The real question, the only question, is this: when will the market lose its appetite for risk? Because when that moment arrives, and eventually it always does, the yen will not strengthen gracefully. It will snap back violently. And many investors will realize only afterward that the signs were visible all along. So if you're wondering what to do with this information, here's the simplest way I'd monitor the situation. Don't watch the yen. Don't watch the headlines. Watch the spread. Watch how fast fear moves through the bond market. When U.S. yields start dropping fast while volatility rises, that's your early signal that the carry trade is trembling. And if that moment comes, USD/JPY won't just move, it will break. And this is only one part of the story. There's a second force, even bigger than the carry trade, that can hit the global currency market in 2025. If you want to understand that, you'll want to watch the next video.